So guys, if you plan on investing for any extended period of time, you're going to make some mistakes. It's inevitable. But not all mistakes are created equal. On one hand, there are errors of commission, which happen when we make decisions that turn out to be not so good. Then on the other hand, there are errors of omission, which actually come from decisions that we don't make. These are missed opportunities that we let slip through our fingers because we hesitated or just failed to act. Warren Buffett wrote about all of this in his 1989 shareholder letter, emphasizing that sometimes the biggest mistakes you'll make in your portfolio aren't from doing the wrong things, like investing in a low-quality company, but from not doing the right things, like letting a high-quality company at an attractive price pass you by. And I believe that I made this exact mistake with Zoetis. I think at one point this was a good opportunity. I knew it was a good opportunity, and I didn't do anything about it. Now, it's been a couple of months since we last talked about this company here on the channel, and just as a quick refresher in case you're not familiar with Zoetis, this company was spun off from Pfizer back in 2013 and is the world leader in animal health. They make medications, vaccines, and other animal health related products with a heavy emphasis on cattle and livestock, as well as other companion pets like cats and dogs, which has been seeing growing demand driven by what Zoetis refers to as the human-animal bond. Basically what this means is that pet owners, particularly Gen Z and millennials, will prioritize the health and wellness of their pets. They consider pets like cats and dogs as being part of the family, and so even during economic downturns, pet owners will still be willing to spend money to treat their pets when something goes wrong. Zoetis has actually done studies to support this as well. In their most recent quarterly earnings call, the CFO referred to a study showing that 86% of pet owners say that they would spend whatever it takes if their pet needed extensive vet care. They've also done studies reporting that if pet owners had a 20% reduction in their budget, they would still spend the same amount on their pet's health. This suggests that Zoetis should continue to see strong demand for its products driven by the younger, affluent pet owners who view veterinary care as being essential. In other words, no matter what's going on in the economy, people are still committed to their pet's health, which obviously bodes well for Zoetis, and based on what we saw come out of this company's recent quarterly earnings call, this is what we're seeing play out. From the call, first and foremost, all of their drugs increased their sales year over year by double digits, with one of them, Librela, which is one of their heavy hitters, growing by almost 150% year over year. And looking at the overall numbers for the quarter, these were very impressive as well. The top and bottom line were both up double digits year over year, with earnings continuing to grow faster than sales, which means that not only is this company continuing to grow, but it's becoming more profitable over time, which if we look at some of the financial metrics, we can see that this has been the trend with Zoetis for quite a while now. I mean, looking at the big three here, the revenue, earnings per share, and free cash flow per share, everything has been straight up and to the right over the last decade, so this is a really good sign. Now moving on, if we take a look at this company's profitability, we can also see that it's an extremely profitable company. The gross profit margins have been sitting comfortably above 60% every single year, at least over the last decade, and if we look at the 10-year average gross profit margin, it's looking really good at 67.3%. Now moving on to the net income margins, this is looking really good as well, and just judging from the chart here, we can see it's gotten a lot better over the years. So 10 years ago, 2014, 2015, we were looking at low teens, even single-digit net income margin, but it's really taken off since then, and since 2018, it's sat pretty well into the 20% range, and now it's even getting closer to pushing 30% for the net income margin, so that's looking really good. And similarly, looking at the free cash flow margin, this clearly has been improving over the years as well, and now at the end of 2023, the free cash flow margin was sitting just around 20%, so all of these looking really solid. Moving on to the debt situation, it's really not too bad at all. I mean, they have about $4.8 billion of net debt as of the close of last year, but as we can see, this is still very manageable. The net debt to free cash flow is only 2.94, which means that if Zoetis were to dedicate all of its free cash flow to just paying off debt, it would take less than 3 years, just less than 3 years for them to eliminate all of that debt. And that's really not too bad. And last but not least, looking at the dividends and buybacks, I mean, we can see the shares outstanding have been trending down over the years. It looks like over the last 5 and 10 years on average, the company is reducing its shares outstanding by about 1% every year. And this dividend chart is just looking beautiful, guys. I mean, this is exactly what you want to see. The 5-year growth rate and the 10-year are both over 20%. So this company's seeing some really aggressive dividend growth, which I definitely think is a must-have characteristic in the dividend stats if you're going to be buying Zoetis, because right now, guys, the yield is really nothing. The forward dividend yield is sitting at less than 1%, but with that, it's still nearly 30% higher than the company's 5-year average yield, so that's good. Now, like I said earlier in the video, it's been a couple of months at least since I've covered Zoetis here on the channel. I first started talking about this company back in April, featuring it in my best stocks to buy video for the month. And at the time, guys, when I first started talking about Zoetis, it was right in here, somewhere between $165 and $170 per share. And soon after that, the price dipped even more, guys, and we saw it get to a low of about $145 per share, which in hindsight was obviously an even better buying opportunity because since then it's seen a pretty steady climb to where it's at now, around $186 per share. So quite the big jump in these last few months. And looking back, it seems like it would have been a no-brainer to have bought Zoetis at the time. The company was a solid grower at a great price with financials that were only getting better, so why didn't I pull the trigger? Well, the answer is simple. I didn't feel I had spent enough time researching Zoetis. Despite recognizing potential with the company, I wasn't all too confident in making a decision without first getting more acquainted with the company. And I actually discussed this in a video from earlier this year talking about the next stock I wanted to buy, where I mentioned that it was a toss-up between Zoetis and Vici Properties. And I just didn't get around to exploring Zoetis further, probably because I was more comfortable with Vici Properties. I felt like it was more in my wheelhouse, and so therefore I spent more time on that company instead of more time with Zoetis. And as you already know, I did end up investing in Vici Properties, and it has worked out pretty well for me, so at the end of the day, it's not all bad. While I'm obviously happy with my decision to buy into Vici Properties, it's worked out pretty well for me so far, and I really like the company, I still wish that I would have worked a bit quicker with Zoetis instead of just letting what turned out to be a good opportunity pass me by. This isn't the first time that I've done this either. I made the same mistake with Rollins. I've talked about that quite a bit here on the channel, and I almost did the same thing with Williams-Sonoma. I vividly remember almost passing on Williams-Sonoma because it jumped from like $114 to $130, and I almost missed out on what turned out to be a really great investment. Even with Vici, I hesitated to buy it because I was worried about having too many REITs in my portfolio. The point I'm trying to get to is that I've let a few really good opportunities just slip by me. And I've almost let some really good opportunities slip by me as well for what I think are probably dumb reasons. And the takeaway from all of this is that I just tend to move too slowly. If I have a hunch that a solid company is undervalued, then I need to be better about exploring that more quickly than I have in the past. But having said all of that, it does beg the question, okay, well, is it too late to buy Zoetis now? And to figure that out, we're gonna take a look at a few different valuation metrics to see what things are looking like. So first and foremost, starting with a classic discounted cash flow calculation. Upon doing this, I got a fair value of around $145 per share, which is quite a bit below the current share price. So based on this, Zoetis would be out of buying range. But if we look at the relative valuation, based on the company's 5-year average PE ratio, this suggests a fair value of around $210 per share, which would still make Zoetis undervalued. So it's kind of interesting to see this difference here. But if we move on once more to looking at the free cash flow yield, based on Zoetis's 5-year average free cash flow yield, this suggests a fair value of around $176 per share, which is pretty close to the current share price. So far we're seeing quite the range of fair values. And furthermore, if we take a look at analyst expectations from Seeking Alpha, the fair value for Zoetis based on this is $214 per share, which is going to be the highest out of the bunch so far. Moving on, looking at Morningstar, they give Zoetis a fair value of $170 per share. So once again, guys, we are really all over the place. And last but not least, well, actually, I shouldn't say that. It is the least. Alpha Spread's base case valuation estimates Zoetis to be worth around $116 per share. So clearly, things are a bit across the board depending on who you ask and depending on which valuation metric you use. But if we were to take an average of all of these different numbers, this would give Zoetis a fair value of around $172 per share, which is below the current share price. So given this, I'd personally wait to see more of a pullback before I would consider buying into Zoetis at this point. And although it may not be an immediate buy at current prices, I still feel like I learned a valuable lesson from all of this. And that's, in investing, sometimes the costliest mistakes aren't the bad opportunities you take. Sometimes it's the good opportunities that you let pass by. And if we take a look at my watch list, I think I'm seeing a pretty decent opportunity with LVMH starting to pop up. And that's what I'm telling you about in this next video right over here. In this one, I'm telling you about my 3 holy grail dividend stocks, which includes LVMH. All 3 of these are like right at the top of my buy list. So click right over here to check them out, and I'll see you in the next one.